Is Grant Cardone's new 10x Space Coast Bitcoin fund just another marketing ploy, or is it a legitimate next level investing strategy taking advantage of the current climate with lower prices today in commercial real estate and the next frontier in Bitcoin and cryptocurrency? I'm about to dissect this so you can decide for yourself. Sort of a neutral perspective. If you're new to the channel, my name is Kawaoka. I'm a multifamily real estate syndicator who has syndicated over $2.1 billion. I've been investing in real estate since 2009, have my own podcast, wrote some books along the way. Hopefully I can pull back the curtain on what's really going on and dissect this Bitcoin real estate mashup. Obviously, stick around to the very end because I'm going to be revealing the lesser known mechanics and risks behind this type of offering. Now let's dive in. Before I go any further, look, I have no association in the fund, not an investor. Don't really know Grant Cardone personally, and I don't want to offend the guy. I've got a lot of respect for him. I've read his book. Don't really know much of him as a real estate operator, more than a fundraiser, capital raiser, good marketer for sure. But we operate multifamily apartments, so I know a thing or two about how you structure these types of funds. So let's dig into the brief bullet style overview of this fund. And when you're looking at his website right now, a lot of the assets that he buys are more of the Class A type of investments. When we started, we bought a lot of Class C, C being things built in the 1950s to 1980s. Class B is more 1970s to 90s. And Class A would be newer stuff, probably built 2000 and later. The problem with the Class A stuff is the cash flow numbers are a lot less. It looks pretty on paper, it's easier to syndicate, but sometimes the value add potential isn't that strong because it's pretty much brand new, right? There isn't much to fix on it. But here he's targeting a 12 to 15% IRR, internal return on investment. Normally in multifamily real estate, you're typically targeting about 13 to 17% IRR. But of course, as I always dig into the numbers, it's all what the assumptions are as opposed to what the projections are. If you guys are interested in learning more about what really drives the model to get to 12 to 15% IRR, for example, what the reversion cap rate is, what is the assumed occupancy, what are you assuming that the rents are going to grow? Super obvious. A lot of times the syndicators will pump it up assuming the rents are going to go up 3 to 5% every year, and that could drive your IRR artificially or optimistically much higher than it really is. What I try to do when I look at a deal from a passive investor perspective is normalize it to 2 to 3% just to pace inflation. And I'm precursing where we're going with this. We're going to be talking about Bitcoin, and that's the huge thing that I'm going to dig on is if you assume that the Bitcoin is going to be going up 4%, 5%, 6% or more every year, that's a huge driver. And I think what's driving these projections, something huge to look for. When I go further into the analysis, I'll keep hammering this home again and again. But just starting at a high level still, looking to boost returns by leveraging Bitcoin, potentially pushing IRs higher. This is just me hearing it from some of my friends who were like, hey, do you see this new spin on this sort of old concept of buying real estate and then having the distributions not go back to investors, but then parlay that into crypto. So again, it's a parlay, right?
That's the one. Parlay.
For those of you guys who like to gamble, the reason why the parlays get super crazy upside is because it is higher risk. I will point that out immediately, right? Essentially, you're playing somewhat of a parlay game here where you're taking the returns from the real estate and puts it into crypto. Again, crypto is a very speculative and volatile type of investment. Now, I'm a fan of the whole crypto thing, don't get me wrong, but make no mistake, it is more of a volatile, high risk, high return type of investment. So let me back up a little bit and get into the fund concept. Pretty cool, I think. I'm not saying it's a good investment. I don't think I'm maybe investing, but what it is combining real estate with the Bitcoin angle. And from a marketing perspective, freaking genius, right? Like how many crypto Bitcoin fanboys are there out there? It automatically draws a lot of attention just from a pizzazz factor, which is, I think, a trademark of the 10X brand. And then combining it with something as time-tested and boring as real estate, going into stabilized cash flowing properties. Stabilized means 90% occupied or greater, and in strong markets, Sunbelt states. I'm not going to really go too much into detail. If this is new to you, I've got a bunch of free courses on analyzing real estate deals on my website, thewealthelevator.com/syndication, if you want to check it out there. But from that perspective, nothing new here. I don't really quite understand the whole Space Coast title, but I think it's a play on words. It's supposed to mimic SpaceX or something like that. But but it's a marketing thing. What I really want to highlight here is that the Bitcoin part is a somewhat riskier side of the equation. The fund uses a portion of the cash flow or the initial capital to buy Bitcoin, hoping for long-term price appreciation. The real estate acts as a stable anchor. Right now, it's really hard to get loans because interest rates are high. The loan to values are really horrible. You're getting loans for 50 to 70% leverage, whereas a few years ago, it would be more like 65 to 80% leverage. What I think is happening here is he's going out and he's buying a lot of this real estate with very low leverage, which in theory is less risky. But now he's combining it with the huge volatility of Bitcoin. Obviously, this is how he's going to augment the projected returns. And I'll highlight that word projected. Could easily go the other way. What I was looking for here is I was trying to see if he was trying to use the Bitcoin as somewhat of a leveraging mechanism, maybe to pledge or stake the Bitcoin to get liquidity against taking a standard mortgage because rates are just so high and LTVs are so low right now. Similarly to how we'll use infinite banking, or some people will do velocity banking. And if you're not super familiar with this stuff, we have a free course on infinite banking. But essentially what wealthy people will do is they'll stake their life insurance and they'll be able to leverage it. Obviously not accessible to average Joes under $5 to $10 million net worth. This is some of the more sophisticated banking activities people will do when you're able to stake an asset, in this case, such as Bitcoin. So this is something that I think not a lot of people know about. This is more on the syndicator operator level that I was just selfishly interested if that was going on. I was never really able to tease out if that was exactly going on. Most times when you see these types of deals, we're just looking at the marketing bullshit, right, that gets put out in front of us, the shiny PDF. When I look at a deal personally, I'm getting the P&Ls, the rent rolls, analyzing the deal. I just wanted to put out some big things that I saw for new investors looking at these types of deals from an LP perspective. The big thing here is if Bitcoin crashes 50% overnight, which you've all seen happen, you face immediate margin calls and you don't have time for a workout plan like you would with traditional real estate. The last few years, real estate went down by 20 to 30%. A lot of times, the situation where the bank and the owner has to come to the negotiation table. This takes months and months and sometimes quarters, where with the Bitcoin involved here, this is fast, liquidated, end of the story. The problem also is counterparty risk, which is a huge question. Which lender or exchange do you trust to hold the Bitcoin here? We've all seen what happens with FTX, and if that lender goes belly up or the platform gets hacked, which I don't think is a huge chance of happening, the collateral is in hot water, and what happens with the real estate that is connected alongside of it. Now, I don't think it's a scam. Some people have said that Mr. Cardone will buy an apartment for $100 million and then sell it to his own syndication for $120 million and call that a scam. I watch all these videos out there, people dissecting Grant Cardone, and they're not operators or syndicators themselves, and they just create these videos to get reactions when they really don't know what the heck they're talking about. Technically, you can do that, and maybe if he's getting a good deal on it that is somewhat fair. I don't think that's cool if he isn't getting a super screaming deal on it, but if it's written into the PPM and disclosed, that is not out of the question. As much as I say that's not cool to do, to pump up the price of value before you sell it to the syndication, certainly not what we do. I'm not saying that it's illegal or anything like that.
Right to jail, right away.
Some things to be careful if you're actually interested in investing in Bitcoin or something like this. There is a big FOMO component to this. Some people recall Bitcoin stories, the guy paying for pizza with his Bitcoin, and now that pizza would be worth like $1 gazillion. Kali used to say if you had one share of Berkshire Hathaway or Microsoft, you'd be a gazillionaire today, right? The reason why we talk about those stories is because they're very rare, yet they're so prevalent in the way that we speak to each other. Bitcoin and crypto is certainly the modern day FOMO out there. Just don't get caught up in the euphoria of it. It's something why I've always invested in things like real estate that has been somewhat time tested. It doesn't move too much, but the way I see it, it's still going to be around 50, 100 years later because people need a place to live. My angst with this whole combination is that you're marketing using something as stable as multifamily, but we don't know the percentage of the funds in crypto. And is it in a manufactured or synthetic leverage type of crypto? We don't know that. Technically, you can call it a real estate Bitcoin fund if you have $10 of real estate and $5 million of Bitcoin. I think that's something important when you do due diligence is like, what is is the asset allocation mix here to know exactly what you're investing in. Because what I'm afraid of is to get 14 to 16% IRRs, I think that's not the greatest, it's not horrible, but I hate to get those projections off of assuming that if it was 100% Bitcoin fund, your projections may be 30, 40% per year. Not saying that's going to happen. It could be, right? As long as you use assumptions that are somewhat reasonable or you state them, you can project whatever the heck you want. It's really how this game works. If you're using Bitcoin or crypto as your base and sandbag yourself and put a whole bunch of fees and other carried interest in here, that's what creates you the ceiling for the operator to take a lot of money off the table legally and be able to still project 14 to 16%. Oh, by the way, call it a real estate fund just so you appease the more conservative minded people out there. So again, nothing wrong with Bitcoin, nothing wrong with real estate. Just know what asset allocation mix that you're investing in here, and is that what you want? I'll interject my own personal feelings about this. If I'm going to be investing in an investment, I want it to be a pure play on whatever I want to invest in, whether that be multifamily, whether that be self-storage or stock market or crypto or Bitcoin. I don't like this commingling stuff, especially where you're not the cook, you don't know the percentages of ingredients here.
Someone cooked here.
An example of this is people are familiar with IULs, Index Universal Life. IULs take into account the stock market. So it's life insurance, which is typically very stable, and we like to use life insurance part of my own portfolio. But when you start to blend it with the stock market, your projected returns are going to be higher than your baseline life insurance, but you bring in a lot more risk, and that may not be what you want. I'll say it very crudely. If that's what you want, just go freaking invest in the stock market and then invest in whole life insurance. I personally like to do things where I have my asset allocation mix separated. Call me old-fashioned, but I don't like to go after all these hybrids. After a while, you don't know what you're really investing in. If you're one of these target fund date type of people, you don't care what the heck you're investing in, like most people out there, cool, you're probably not watching videos like this on YouTube. We'll use whole life insurance as the base of that asset in infinite banking. People say all the time, why don't you use IULs to get a little bit higher returns? We could, but you're introducing a little bit more risk, and it's not a pure life insurance play at that point. It is a blend between life insurance and the stock market. Again, that's essentially an IUL, which, by the way, I'll be careful. A lot of people like to do multi-level marketing with IULs because they have a really high fee structure. I just see a lot of that, but not the topic of this video today. If you want to invest in real estate, what I say is invest in real estate on its own, whether that's in rental properties. If you're a new investor, you can check out my free e-course on buying little rental properties at thewealthelevator.com/turnkey, or you can invest on the syndication side. If you're more of an accredited investor, this is where we put together offerings like multifamily deals or other private equity deals. So we do what I'm talking about here. But if you're going to want to invest in Bitcoin, etc., what I would say is do it completely separately. What's nice these days is there's so many ETFs. A lot of the institutions have somewhat adopted it. So if you're like me and you're uncomfortable holding a little USB dongle and forgetting your passwords, you don't have to worry about that when you invest through an ETF or institutional product. Now, when you do that, you do lose the decentralization, which is why I think a lot of people do invest in that type of stuff, because part of the play on Bitcoin, people like the detachment off of nations controlling the monetary supply. Another example of a non-pure play investment is a deal that I saw come out in 2021. It was like a Bitcoin mining machine. On the surface, makes a lot of sense. It's really cool. Again, it's that pizzazz factor of mining and creating Bitcoin. But when you really dig into it, you realize that a lot of the projections were based on what the heck the price of the underlying Bitcoin was. In that case, they were likely using a very high assumption of what they thought Bitcoin was going to go up. If you were to do sensitivity analysis and you were to bring down the assumed price of Bitcoin going up, the mining machine barely made money. It definitely wasn't worth the risk. By the way, that Bitcoin mining machine turned out to be a huge scam. I never invested in it, but people told me later. Very similarly, when you look at some of these oil and gas deals out there, take into account the price of oil. The lesson learned here is to really understand what is driving the model on the projections. Getting back to it, as a high level on this fund, Cardone is known for making big, bold claims. He is pretty progressive. I think the imagery that he's projecting projecting here is cool. It's a good idea, but I personally just wouldn't invest in it because I would like more of a pure play, like I said earlier. If you are going to invest, I would really try to understand what is the actual ingredient mix of the Bitcoin versus the real estate. And if it's more than 20% Bitcoin, just know that in my head, the 14 to 16% IRRs are low at that point. The more crypto that you get in here, the projected returns should get higher and higher. And I say that the potential returns are higher. That's what these returns are. When you guys look at these websites and all these things, the projected returns are BS. We don't know what's going to happen. As long as the operator uses somewhat reasonable assumptions to get to those numbers, they can put anything on the paper. That's really where it falls in your jurisdiction of understanding and doing your own due diligence. And what I think is getting around other purely passive accredited investors, which is why I created the Wealth Elevator community in the first place. I did want to leave you with one last bonus tip. If you are going to invest, make sure you read the PPM, specifically do the Control F thing and scroll down to the fee section. Typically with these mass marketed deals where they're targeting retail investors, and retail investors are you watching YouTube, that'd be you. Typically the fee structures are pretty high. Normally acquisition fees are between 1 to 3%, but be careful of all these other hidden fees in there, like loan funding fees, I closed the deal fee. There's just a lot of these fees out there, and I detail this in my syndication e-course, which you guys can access for free. I just want everybody to go in eyes wide open when they go into these deals. And then, hey, if you'd like to book a call with myself, join our community, you can join at thewealthelevator.com/club.